Happy Monday, options traders. And we got a really good question last week from one of the traders in our group asking about levered funds. These levered ETFs, been popular for numbers of years, but lots of people like to trade them. And this person's question was, is there an advantage to trading the options versus the levered funds? Kind of a multi-part question, but part of my answer was talking about this idea of a daily reset. And what I wanted to really cover in this video is, what does that mean? That's the thing that most traders don't understand, is that these are reset daily and what that does to the returns over time if it's a volatile underlying. So let's go find out more about this. Levered funds, what is the daily reset? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So levered funds, as I said, there's lots of them out there, but it's just a family of these ETFs generally, or ETNs, that use leverage to increase the returns. Now, of course, because of the risk-reward relationship, we know that that also means you are increasing the risk. The downsides are going to be much bigger. So they get this leverage from a number of methods. It's usually from borrowing money, futures contracts, swaps, other derivatives. I'm not going to go into detail in how they do that. They could all go about it in different ways. But the idea is that it's just using leverage to magnify these returns. Most of the classifications fall into a 1.5x fund, 2x, or 3x. And all that means is that if you have a 2x fund, if the underlying goes up 1%, you make 2%. If it goes down 5%, you're down 10%. It's just magnifying the returns in percentages on that underlying by a factor of 2. But now here's where it gets confusing for traders. Most of these funds use daily resets, and that's what throws people. And they'll say, well, the fund went up 10% over the month. If I have a 2x fund, I should be up 20%. Not true. You could be way down. So for example, let's take a look at the QQQ levered fund. This is from ProShares, and it trades under the ticker TQQQ. And if you look right down here, it says 3x daily. Almost every single fund, now there are exceptions, some do monthlies, but they're rare. The vast majority do a daily reset. Now on top of it, they're also going to hit you for an expense ratio, which I've talked about in previous videos. This is not too big, 0.84, but it's still there. It's not zero. And so if you understand options and strategies, you're generally going to be far better off trading the options on the underlying as opposed to trading the levered fund. So to understand exactly what this means to have a daily reset, let's jump over to an Excel spreadsheet. Okay, so now we're into an Excel spreadsheet, and I want to start with a little analogy because I think that will help you to understand what's happening and why this daily reset can be so damaging. So let's look at a one-year deposit at a bank that's paying 10% interest. I know that would be nice, but it's just to make the math easy. And let's say that the bank pays annually. What this means is that if you deposit $100, nothing happens throughout the year until the end of the 12th month. And that's when you get your 10%. So your balance just sits at 100, even though theoretically it's growing, nothing's happening through here. And then all of a sudden, in one shot, it jumps to 110. So again, the point to see is that there are no cash flows in here. These are just zeros. So it has no effect on this final outcome. Now, what if the bank pays quarterly, every 3 months? Well, if it pays 10% annually, remember an interest rate is always an annualized number, then it's going to pay 2.5% per quarter. Now things are going to change up a bit. After the third month, the first quarter, the bank says, okay, we're going to pay you 2.5%. That's just 1/4 of our 10% rate. So see, unlike under annual compounding, it's not a zero. It's 102.50. But then on the end of the second quarter here, month 6, it's not just taking 2.5% on your 100, it's taking it on 102.50. See, now we're getting this compounding effect. And that's why at the end of 12 months, here we have 110.38. It's a little bit bigger than you might have expected, even though the interest rate is 10%. And that's because these cash flows were hitting. You're going to find out that's really the trick to understanding this idea of daily resets. So if we go to monthly, now the bank is going to pay 1/12 of 10%, but it's going to do that every single month. So now your balance shows 100.83. See, notice under annual compounding it was a 0. Under quarterly compounding it was a 0. But now we've got a cash flow in here that's going to affect things. So in month 2, we get 1/12 of 10%, but we get it on this balance, on the 100.83. And so that continues on, and now we end up with 110.47, which is a little bigger than 110.38, which is bigger than 110. So the idea to see here is that as these cash flows are being changed throughout the sequence here, throughout the year, it changes these outcomes. So see, again, in the first example here, nothing mattered until we got to the end. But with quarterly compounding, this number right here depends on this number, and this number depends on this one. This number depends on this one. When we go to monthly, this number depends on this one, the previous one, this depends on this one, and so on up the line. And you're going to see that's the idea of understanding this idea of daily resets. So let's jump over to a second sheet and see how this applies. So let's say we have an index that's trading for 100. Again, it could be the QQQ, the SPY, a stock, whatever happens to be this underlying. I'm going to assume it's an index. And let's just make it 100. And let's say, I'm going to make it really volatile just to make the point. Let's say the next day that the index closes at 105. And the next day at 110, 115, and so on up the line. And then we start fading a little bit, and we come back here to the starting point of 100. So notice that we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days of changes. We started at 100, we ended at 100. So this is where traders get confused. They say, well, the index started at 100, ended at 100. If I had the 3x fund, I would be unchanged. But see, that's not a daily reset. That would be a 10-day reset. Just like with the banker depositing interest, if the fund came in every 10 days and said, let's now check these values, that's not what's happening. They are doing it every single day. So now what we have to do is say, okay, when the fund went from 100 to 105, that was a 5% increase. When it went from 105 to 110, that was a 4.8% increase. When it dropped from 120 to 115, that was a 4.2% drop. That's the minus 4.2 right there. So what the fund does is that every single day it says, all right, the index went up 5%, we're going to pay you 15%. But see, now that cash flow has changed. It's not 100, it's 115. And so now you've got a bigger pile of money to compound if things go your way, but it can be devastating on the way down. So the problem is if we get volatility. So now look what happens when we go from 105 to 110. You picked up 4.8 on the index, which is 14.3% on the 3x fund. So now your balance is 131.43. So if we keep going through this every single day and either adding 15%, adding 14%, and so on down here, subtracting 12.5%, subtracting 13%, we don't end up at 100. You end up at 87.7. That's 12.3% below what you thought. Because remember, in this example, you're coming out here looking at the index at 100, 10 days later it's 100, you're assuming that your 3x fund would be unchanged. And again, that would be true if the fund said we're going to check it every 10 days and then settle up. That's not what the fund is doing. It's saying we're going to settle up every single day. So even though the fund started at 100 and ended at 100, you ended up at 87.7. You lost 12% of your money. Why? Not because the value of the fund changed, but because of the volatility in between the starting and ending points here. And this is what's called the volatility drag. If we get lots of volatility, even though we can start and end at the same number, it's going to reduce your balance. And this is the big danger of the levered funds. If you read their prospectuses, it will tell you the fund is expected to lose value over time. This is why you do not want to throw this into an IRA and say, let's just hang on to it for 30 years and I'll get 3x or triple the value of the QQQs, right? Free leverage, not true, bad idea. These are really for very short-term uses. So now to make the point, let's put in some higher vol. I'm going to start the index at 100 and end at 100, but now I'm just going to make these jumps bigger. And look what happens now. Now you're down almost 28%. So you started with 100, you ended up at 72.41. That's a loss of 28%, even though the index started at 100 and ended at 100 over 10 days. So do you see what's happening? Yes, if the fund said, okay, every 10 days we'll settle up, yeah, you'd have $100 right here. It'd say, well, it started at 100, ended at 100, that's a 0% increase or decrease, so your value of your position is still the same. But they don't do that. They do it every single day. And because these cash flows are changing, now these percentages matter, what's happening along the way. Now, if we have low volatility, same thing, we're going to start at 100, end at 100, but I'm going to make the changes pretty close to 100. Not a lot of variation. You can see these percentages are, the greatest percentage is 2%, but most of them are very small. Now look what happens. Now you're only down 0.4%. You started with 100, you ended up at 99.64, even though the fund started and ended at 100. So again, traders will go, well, what happened? I don't get it. How come I lost money even though the fund is unchanged? What you're missing is that it's a daily reset. It didn't just jump from here to here like we saw under annual compounding. All of these cash flows in the middle mattered. And now finally, let's look at a trending market. This is where a levered fund can outperform. So now we're going to start at 100, but we're going to let it trend up, and we're going to end at 110. Now, notice when it's trending, it doesn't mean it always goes up. I go 101, 102, 105, 108. See, here it went down to 106, then back up 110, went down to 108, and then at 110. But overall, there's an upward drift. So even though the index rose 10% from 100 to 110, you might look and say, hey, if I had this fund, I'd be up 30% because it's 3 times 10%. Not true, because in that example, you're looking at a 10-day reset. If it's reset daily, you're actually up 31.8%. Beat it by almost 2 percentage points. You would expect it to be up 30%, but it's up about 32. Why? Because we're getting this positive compounding. We're not taking these big hits when we take the big drops like we saw before. Everything's picking up, so it's working like compounded interest. So in a trending market, assuming it's a bull fund, you can outperform. So if it's a short-term play that you're looking for and it's trending and you're right, yes, the triple fund can certainly outperform its stated leverage. But now let's jump over to the risk graph for a call option. If we have the $100 call, remember we have curvature here. So if this is an option on the levered fund, now we have leverage on top of leverage. And things can get really crazy because we've got gamma. So that's one thing I would probably avoid, is playing options on the levered funds. But if you understand options, I think doing options, which even for stock replacement on the SPY, it's easy to get 3 or 4 to 1 leverage. Plus you've got gamma. That's going to be a whole lot easier to manage without this daily reset. And as I've mentioned in previous videos, little side note here, this curvature, leads to something called Jensen's inequality. And what that means is that the profit at the average stock price is going to be less than the average profit. So what that means is that because of this curvature, it's accelerating you if things go favorably, but it's decelerating you if it goes against you. See, you don't get that with the levered fund. So I hope this helps to add a little more insight into that person's question. If you're going to trade the options on the levered funds, it's the Wild West. Lots of things can happen completely counterintuitive to what you think should be happening. And I would probably not suggest that. If you want to take the triple levered fund or double fund, then just trade the fund. Be aware that you should only be using it for short-term trades or outlooks. But if you want to use the options on the index, get the leverage from the options, not from taking options on the levered fund itself. But if you understand your hedges, rolls, morphs, gamma, and options in general, you can put yourself in a much more manageable position to get tremendous leverage and not be at the mercy of daily resets. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.